I think this is such a huge issue, and I would argue that the future of the dollar as a reserve currency is our national security issue. Our deficits are out of control, and if we don't take measures to shore up the global confidence in the dollar, we're going to have a massive problem on our hands in terms of financing those deficits and potentially having a real hyperinflation problem here. So actually, I did propose to the Trump administration, and I haven't had any real reaction, no bites yet to this, that they consider making the interest on treasuries tax-free as a way to create a domestic source of buying for our paper rather than relying on foreign central banks. And that would help reduce our borrowing costs and shore up our financing at home rather, again, than relying on the kindness of strangers. But putting a pin in that, I mean, I think as you articulated, we've seen this move by all around the globe and really spearheaded by China, Russia, and the other BRICS countries who just had their meeting last month where they're, continue to make real progress in moving away from the dollar. And as you mentioned, the linchpin for that is really what comes down, what happens to the petrodollar standard, and do they continue to transact oil in dollars or other currencies? And we have seen a lot of shifts at the margin to trading oil in other currencies. But as long as Saudi and, OPEC maintain that dollar reserve standard, in theory, we should be okay. But I think it'll be interesting to see what the Trump administration does to really shore up that global confidence in the dollar. But it's a key issue. And this is one of the reasons why I've been bullish on gold so long, is that we have seen this global exodus. We do have this existential problem of how we're going to finance our deficits in this demand vacuum that they're leaving behind. And no one has really proposed any clever solutions. And in the absence of any solutions, the dollar goes lower and gold goes higher. So I'm waiting to see what they propose here. The issue is, how are we going to finance these deficits? And that is really what's been driving gold all year. As you've seen, the deficit math has gotten so bad to the point that we're now, pressing $1 trillion on interest payments alone. And I think that sort of started to come into the mainstream discussion for investors and the financial media. And that's really helped to drive gold. But I would also underscore that the demand that we've seen for gold has been almost overwhelmingly to this point from Eastern buyers. It hasn't been here in the West. It hasn't been retail investors so much. It's really been those BRICS countries and people in Asia, et cetera, who are seeing what's happening and, here in the US with their deficits and taking action, which means there's a lot of room in theory left for the Western investors to get involved here should they begin to rub their eyes and wake up to the reality. So I do think there's more room to go. I just keep coming back to who is going to finance these deficits. It's math. We're issuing $2 trillion in paper a year, and foreign central banks, per the latest Treasury capital flows, took down $4 billion over the last 12 months. So they're effectively buying zero. What we're relying on now in terms of deficit financing is private institutions. And I think mostly right now it's hedge funds doing this Treasury basis trade, which is a little esoteric and frankly a little terrifying because it sounds fairly reminiscent of LTCM, which going on there. It's not a sustainable or a reliable source of financing over the long haul. So this is an issue that the markets are going to have to grapple with. And every day that we see Treasury yields move higher brings that issue forward into the reality. If history is a guide, there were no wars and there was peace pretty much all over the world during his first term. So I would anticipate that we'll see things calm down. However, I do struggle with this one because it doesn't appear that there was a geopolitical risk premium associated with Ukraine or the Middle East in gold. It was really more the de-dollarization shift and the weaponization. I would say it wasn't the war in Ukraine, it was the weaponization of Russia's reserves that really precipitated the move in gold. Because if there were some kind of geopolitical premium in there, you'd think you'd see the same in treasuries, and you clearly haven't seen that. So that safe haven, that rush to safe havens hasn't been evident in treasuries. And so maybe that's something that isn't reflected in the gold price, which, again, would just underscore how deep the real demand is from real money buyers in those BRICS countries and the Far East as they look to hedge what they see as the inevitable debasement of the dollar. I thought 3,000 was a layup. We should go through that like a knife through butter. Now, I think there'll be some broad reassessment because obviously the outcome of this election changes the economic backdrop. The number one cure for deficits is growth. So if we can get this economy really growing, and I happen to be a pretty healthy skeptic about the veracity of the government statistics that are coming out. When you look at the gap between the statistics as reported and what consumers say they're feeling on the street, when 3 out of 5 Americans tell you we're in recession now and we have been since March of last year, clearly there's a mismatch between what the government's reporting and what people are actually experiencing. So if we have a new policy that helps support growth and CapEx picks up and employment really gets to a point where people don't have to work 2 and 3 jobs to make ends meet, that's a game changer and could help really at least restrain the growth in this deficit, which is, kind of now in this doom loop where higher rates are feeding the interest expense. But we'll have to see, how quickly can these policies get implemented, what happens again with the House and Senate, and how do these bills look when they finally get through, how much of what Trump has proposed actually comes to fruition. But it's certainly the better outcome than the alternative. And, I do think that it's less favorable for gold, but that doesn't mean it's unfavorable for gold. I think it just means, we still have to deal with this massive financing issue, but there's a chance we might get some solutions that will begin to chip away around the edges. But this is a big, big problem. And it's not something that, Trump on day one can solve and restore the confidence in the dollar. This is going to be a big project and will take a lot of work and a lot of time. I'm not invested in the stock market. I am in hard assets because I fear that the only real solution here, the palatable solution, is to eventually inflate away our debts at this level. There really is no other option. So that has been my position. And I think what's interesting is that until today, if you look at the market action so far this year and over the last 12 months, what we've seen in terms of equity gains has been an inflation illusion. The S&P has trailed gold. The S&P is actually down in real terms, but everyone looks at it, every day without considering the silent inflation that's going on in the background, and they think they're doing great, but they're really being debased. And that's why gold is massively outperformed. It's a little bit of an abstract notion, but I think people really need to wake up, just like the man on the street realizes that the price, he's paying more for the same amount of stuff than he was. It's the same with the S&P. You're still buying one share, but you're paying a lot more. And meanwhile, gold is telling you that you're losing the purchasing power of your dollar every day. So I think it's important for people to focus. People are very dismissive of gold, but looking at the market performance relative to that yardstick is crucial, I think, just to keep, perspective on real versus nominal gains. I'm long gold and a little bit of real estate. I do have a little bit of exposure to EM because, you have a lot of resource producing economies in the emerging market. So it's basically a kind of a levered bet on the commodity space. But I feel like I can sit there, and I actually have been being paid to sit there and doing very well in those positions while I wait and see how things flesh out. Because right now we now have a little certainty about the election, but there's still plenty of uncertainty out there in terms of what happens with the BRICS and how we are able to shore up confidence in the dollar and what happens with this impact of this kind of doom loop that's set up here with higher interest rates mushrooming out our deficits. And obviously days like today aren't helpful because while markets are discounting more growth, they're pushing rates up, which is just mushrooming that deficit farther and bringing forward the day when we're, the day of reckoning, essentially. With regard to the federal government, they can buy themselves time. They have the power of taxation and a printing press. But these higher rates that are feeding the doom loop in the deficit are also impacting the private sector. We've obviously got corporations that are massively record leveraged, and they had been rolling paper short term in anticipation of this Fed rate cut. All of last year, the junk yields and spreads came down in anticipation that when the Fed did the pivot, rates would come down. And so everyone basically was like, look, if borrowing costs for our company that we're lending to are going to come down a year from now, we may as well throw on the lifeline now just to keep them, there's no reason to wait because it's going to happen eventually. And now that we're seeing rates go back up, I think that calculus shifts. And so you're going to have a problem for a lot of the lower echelon of corporate America that already can't service its debts. And that unfortunately describes a much bigger swath of corporate America than most people imagine, because they focus narrowly on the S&P 500 or even more narrowly on the top 7. But when you realize that like 40% of small cap companies are unprofitable, clearly they're not servicing their debts. 17% of mid caps are unprofitable, and 7% of the S&P, which is a pretty high number for the top 500 companies in the country. So I think that's going to be a major issue. And then we haven't even talked about the banks. The banks have been sitting on $500 billion on unrealized losses on their treasury and agency, on their safe securities. That's not going anywhere. It hasn't been cured. The whole idea was, well, that's just temporary. The moment the Fed pivots, all those losses will be cured and their balance sheets will be made whole again. That's clearly not happening. And in fact, maybe getting worse. So those issues, I think, are the ones that are really going to come to the fore first. The deficit probably has a longer fuse. I think the fuse for the deficit is expressed through the dollar. So we'll have to watch gold for that. But I think these private sector and banking issues might actually precipitate the Fed going back to QE sooner. Right now, no one thinks they're going back to QE at all. I happen to be one of the fringe people who thinks it's just a matter of time before they start re-expanding their balance sheet to try to contain the slow motion train wreck in the treasury market. The employment data has probably been the worst in terms of the inaccuracies there and the false impression they're giving of strength. And you don't really even have to drill that far beneath the surface of those monthly headline numbers to see how bad things are, because you've had this yawning gap between the payroll survey and the household survey for a long time, and it's just gotten wider and wider. And the thing with the household survey, the payroll survey, if you have to work 2 or 3 jobs, it looks like everything's great, that you're adding 2 to 3 jobs to the headline job numbers. But when you call up a household and you ask them, are you employed? There's only one answer. Yes, I'm employed. So that's why you've had this situation where people get all swept up with excitement about how strong payroll numbers are. But what they miss is that multiple job holders have hit, record highs. We actually have a decline of over 1 million jobs in terms of full-time employment and a huge increase in part-time employment. And I think what's happened there is obviously, as the economy has started to slow, companies who were chastened by how difficult it was to get people back to work after COVID are reluctant to let people go. It took them so long to hire people back that they don't want to chop heads immediately. So what they've done is they've cut hours, and they've cut everyone down to part-time hours. So those people then have to go out and take out a second job to make the same amount of income and support their families. And so I think that's the silent story that's been going on for the better part of a year and a half behind the curtain, while everyone has been, celebrating these strong payroll numbers. And that's why the consumer confidence numbers have been abysmal, and their assessment of the job market has been, absolutely horrible. And their assessment about the likelihood that their income outpaces inflation has been the worst in history. So clearly that employment picture that we're seeing every month has been really misleading. But again, things have changed now. We have a new president, or a new administration with policies that will be radically different from the policies that we've seen over the last 4 years. And hopefully, if we go back, I have to remind myself that in 2016, when Trump first won, we were kind of in the midst of a massive corporate credit crisis. We had a huge increase in corporate bankruptcies because of backup in interest rates. The economy was clearly slowing, and yours truly here was forecasting that we're heading into recession. And then Trump won, and he immediately implemented his tax cuts and slashed regulation. I mean, he was cutting regulation like crazy. And the economy did an absolute U-turn, and the corporate credit market calmed down and enjoyed a new up leg. So I'm mindful that that can happen again. You know, expectations can create the reality, especially since the markets have seen this show before. They saw it 4 years ago. I'm hopeful that the economy can really recover and we can get people to a place where their real incomes are growing and they're able to save and pay down their credit card debt and really take breathe a sigh of relief. But I am concerned about this push-pull between stronger economic expectations and interest rates. And we're seeing that already today in terms of the backup in interest rates across, the credit markets. That's a major headwind for economy as levered as ours. So we really have to always keep that in mind.